Hi, and thanks for joining. My name is Sean Bjork, and our role is to serve as the independent investment fiduciary for your organization's workplace retirement savings program. What does that mean in English? Our job is to help you make the most out of the plan, your workplace retirement savings plan, and to help support the important financial decisions you're making, not only in that plan but beyond. And so, along those lines, today our topic for the quarter is Money 101. And really excited to walk through this with you today. I learned a lot in creating this content, and there's a lot of stuff in here that I'm going to be working on myself, and excited to see how that goes moving forward, and really hope that you get as much out of going through this as I did in creating it. So with that, I'm going to go ahead and share my screen, and we will get started here for the quarter. So what you're looking at here, Money 101, brilliant on the basics. That is a line I absolutely stole from a friend who served in the Navy for a long time, was in the SEAL teams for 20 plus years. And he talks quite a lot about, being brilliant on the basics. And that's something where, you see it in professional sports, right. Folks going out and professional athletes going back and really focusing in on the fundamentals, right. And that's what we're going to talk about today, right? Because if we have a strong, solid financial foundation, we can really build on that with our goals for the future. And sometimes that ship gets off course, right? And we need to bring it back, and we need to recognize that that's not an overnight process. So we're going to talk about a lot of stuff today, but my hope is, again, you're going to take as much away from it as I did in creating it. So with that, we're gonna cover. I don't know if you like to cook. I really enjoy cooking, and we do in our family. But I'm not the best cook. I can follow a recipe though, and that's really what we're going to try to accomplish today, right? Is we're going to try and give you the recipe for a strong financial foundation. We're going to talk a little bit about the ingredients. We're going to give you the recipe, and then we're going to start cooking, right? Because none of this matters until we put it into action, and that's what our goal is going to be for today. So before we dive in, this is potentially my favorite slide in the deck. And what you're looking at here, right, is two circles. And if we look at those two circles, one circle is things that matter, the other is things that I can control. And where those two circles overlap, that's where we're going to spend our time. It's incredibly easy when we're talking about finances and personal finance, to get lost in the sea of either things that don't matter or things that I can't control. And we're really going to focus our bandwidth in on things we can control that really matter. And especially if you watch the financial media, right? Their job is to throw a lot of things at you that fall outside of those overlapping circles, right? So we'll talk about that. So what are the ingredients that we're going to cover today? We're going to talk about building a budget. We're going to talk about really trying to cut out what doesn't matter. Paying down debt, some strategies there. Emergency savings. If there's one place to start, right, that's where that next dollar goes. If we don't have an emergency savings, we're going to talk about that. Investing for retirement, having a plan. Again, that's what we're talking about today. And then the power of automation, right? Automate, automate, automate. And we'll talk about how to do all of these things. So step number one is creating that budget, right? Figuring out what's coming in and what's going out. This is a lot of people think about making a budget, sort of similar to going to the dentist, right? And it can be a little bit daunting. I personally am in that exact same boat, right? So I was talking to a good friend who's a CFP, and we were talking about budgeting. He said, "Hey, the strategy I recommend to my team is we look back 3 months. So we take the last 3 months of our bank statement, our pay stubs, and our spending, and then we track the next 3 months. So it's a 3 month process. You don't have to do it overnight. You can chip away at it." And he said, what's really interesting is how different that spending looks the second 3 months when you're tracking it. So just something to keep in mind, right? You might see some behavior changes in there, right? So let's look back 3 months. We'll look forward 3 months, and we'll have a really good idea of what our cash flow looks like. And then in terms of budgeting, there's a really simple rule up on the screen here. It's the 50-30-20 rule. You'll sometimes hear it referred to as the 50-15-5 rule. But really the 50-30-20, we're going to say 50% goes towards essentials, right? That's going to be your housing, getting to work, your clothing, right? But clothes for work, right? So no extravagant or unnecessary purchases, right? Just essential items. About half of our take home, ish, should be allocated to that, right? No more, certainly less if we can, but really no more than that. And then 15% toward retirement and 5% toward emergency savings. So 20 is really savings, right? If we think about the 20%. So again, of the 20, 15 to retirement and 5 to emergency savings. And then the 30 goes toward fun. So 30% to fun, right? And if you're spending more than 30% on fun, you're having too much fun. So this is a really good guideline. Strongly encourage you to include your family. My spouse and I sat down and started going through this process, and everyone, kids, if they're old enough, right, include them in their spending. Everybody's going to have a different take on what is essential and what isn't, right? Some of that's going to be fun to talk through, but certainly including everybody is a great place to start. So if we do find that we're paying down debt, right, we're paying maybe some high interest, consumer debt, or we've got some student loans we want to pay down, what are some strategies after we go through this budgeting exercise and we decide, hey, I want to pay down and get some of this debt and servicing it out of the picture, right, out of my life? So I'm going to give you two strategies to think about. One is, we call it the debt blaster. It's kind of fun to think about, fun to say, right? And really that's where you sit down, you do an inventory, you say, okay, what do I owe and what are the interest rates, right? If there's multiple sources, and you pay off the highest interest rate debt first, and then you make the minimum payment on everything else while you really focus in on that highest interest rate debt that you're carrying. And this strategy is the most efficient, right? But it can also feel like you're not making any progress, right? It can be really hard to feel like you're making a lot of progress. So another strategy is the snowball, right? The debt snowball. So you take your lowest balance, you make minimum payments on everything else, and you take your lowest balance and you aggressively pay that down. And when you're done with that, you go to the next one, and then the next one, and the next one. You might pay a little more interest over time, might be a little less efficient than the previous strategy, but often it feels like we're making progress. And none of this stuff matters unless we do it, right? And so whichever one works for you is the one that's best, right? And so just, again, something to think about, but two different strategies if we do have some debt that we want to pay down. So now that we've talked about taking, inventory, right? Making a budget, any debt that we want to, aggressively pay down. Now let's talk about the future, right? And let's talk about the difference between saving and investing. If you remember back a couple slides, we talked about the 50-20-30 rule, right? So the 20 is savings, 5% is going to emergency savings, 5% is going toward retirement. What's the difference, right? So if we think about investing, we're taking some risk for a goal at some point in the future. And we're willing to accept some risk for the possibility of appreciation or of return. Whereas savings, we really want that to be just the goal of that bucket is to be available if we need it, right? Rainy day fund, the dishwasher breaks, the air conditioning breaks. I can speak to experience over the weekend on that one. That was a surprise I wasn't expecting, right? So when we think about savings, we want to have a bucket that we can, tap if we need to in a rainy day. How much should that be? Depending on who you ask, it's going to be somewhere between 1 and 6 months of your spending and essential needs. So, think about that, and also think about the fact that we don't have to get there overnight, right? So if we just start with 5% of every paycheck and we sock that away, what does that look like, right? So, and we'll talk about some strategies to do that. So it's important to think about the difference between saving and investing. So when we think about investing, right, has anybody noticed inflation ticking up, right? It's in the news, things are costing more. Bacon, near and dear to my heart, 18% year over year increase. So just anecdotally, right? But, certain things are costing a lot more. And so we need to make our long-term investments being mindful of the fact, that inflation is a real thing and it can really erode our purchasing power. So the chart you're looking at here is, how many tickets to the movies could you buy with 20 bucks in 1950 versus 2020? I took one of my kids and his friends to the movies recently, and I can tell you it wasn't 10 bucks a ticket. So I don't know what what movies they're going to here, but just something to keep in mind, right? So okay, so now we've talked about saving versus investing. We talked about budgeting. We talked about paying down some debt. So now that we're going to invest, what are the ingredients, right? What are the things that we're investing in, right? Stocks, bonds, cash. Best way to think about it, right? Cash is cash. That's what our savings are traditionally going to be in. It's liquid, usually not going to keep pace with inflation, but kind of close, right? And the real benefit of cash is that it's there. It's liquid when we need it, right? Longer term goals, we're going to look at stocks and bonds, right? Best way to think of it, bonds, investing in bonds, you're a loaner, right? That doesn't mean you're like a drifter with a leather jacket. That just means you're loaning money. If you buy a corporate bond, you're loaning money to a company that's promising to pay you back with interest. You're higher up in the capital structure. If an organization goes bankrupt, you generally speaking will get some of your money back, not all usually. Whereas stocks, you're an owner, right? You're a part owner in a company. If you're very low down in the capital structure, you have a lot of upside, but if the company goes bankrupt, poof, right? All that money's gone. So, we're looking at the risk versus reward spectrum here, stocks at the high end, cash at the bottom end. So, what are those ingredients? And if we think about ingredients, right, and we want to, build a nice, healthy diet or a healthy meal, we kind of want a little bit of everything, right? We want some grains, some vegetables, some fruits, some protein, some dairy. Well, your portfolio is no different, right? We generally are going to want some stocks, some bonds, some cash, some alts within reason, right? And then some other, right? And so really important to think about a balanced portfolio in this analogy that we're using here, about knowing the ingredients, right? So, and if you have a plan, great. That you're already doing a lot of this stuff. If you're using your plan's default, which is likely the target date fund series in your plan, a lot of this is already happening on your behalf, right? So invest in yourself, right? What do we mean by that? We mean that, we want to match the risk level we're taking for the time period and how much reward, we're looking for and how much risk we're willing to accept, right? So, cash again, going to be, on the low side, on the return side, generally going to barely keep pace with inflation. Stocks are going to historically have much more return potential, but also much more risk, with bonds being in the middle. So again, important to think about. All right, so I'm going to take a minute here. Here's a quiz. Who sees the pattern? Trick question. There is no pattern. So I have had clients describe this to me as the world's ugliest quilt. And what you're looking at here is year by year. Those are the vertical columns, or the years. At the top is the asset class that did best in that year. At the bottom is the asset class that did worst in that year. There is no discernible pattern year over year. So really hard to call what's going to be the winner and the loser in any given year. If, however, we code these asset classes by risk, we do start to see a pattern. So what you're looking at here, same, year by year by year, we have the hotter colors are the riskier asset classes, and the cooler colors are the, more conservative asset classes. We do start to see that over long periods of time, not every year, but over long periods of time, we tend to see risk driving return, right? Risk and reward are directly related. There is no free lunch. So this is a really important concept to hammer home. So now we've talked about investing. We've talked about what drives returns. We've talked about what the ingredients are. It is important to note that it's possible to invest while paying down debt, right? So what you're looking at here really is just a quick graphic from JP Morgan, where they're running an illustration of a 15-year period, one where somebody pays down all their debt first and then invests. The other is where they invest and pay down debt. And what you see is, you're going to pay a little more interest over time, but you also end up with more in your investment bucket over time. So important to have a plan. The right mix is the one that works for you, right? So that's important to recognize that there's no right or wrong way. But generally speaking, if we're investing for long-term goals like retirement and we want to pay down some debt, considering potentially trying to find a balance between those two goals and execute on both of them at the same time, if you can, is a strategy to consider. All right. So when we talk about market volatility and what the markets do, and we talk about risk, it's important to note that market volatility is normal, right? It's normal. It's expected. When we're taking risk, that volatility has to be there, right? So what you're looking at here on the chart is year by year, going back to 1980. The green bar is where the market ended for the year. The blue gray dot is the lowest point, the lowest negative that the market hit during that year. So you can see that if we pulled the ripcord at the bottom in a lot of these, we would have missed out on a lot of positive years. So the key here is that volatility is normal, accept that, and find a risk level that you're comfortable with that's going to help you match and realize your goals, right? So another thing to be mindful of, there's always a reason to sell stocks, right? So, when we think about the chart you're looking at here, look at all these events, right? The Vietnam War, World War II, the Great Depression, the Cuban Missile Crisis, the SARS outbreak, the Gulf War, the global financial crisis, right? The most recent pandemic. All of these things were reasons to sell stocks. Having said that, what we really want to consider here is, the overall resilience of the US stock market, right? And that's really important to consider. All of these gold bars that you're looking at, those are all recessionary periods, right? So again, always a reason to sell stocks, but really important to keep a long-term perspective, right? So what are some strategies for volatile markets? Well, number one, stay put, right? Stay invested. So what you're looking at here is, what if you stayed invested over a hypothetical 20-year period in the S&P 500? If you stayed invested, with these assumptions here, you would have had $647,854 starting with a $100,000 investment at the beginning of that 20 years. What if you missed the best 5 days in a 20-year period? So just 5 days, the best 5 out of 20 years, look what happens. $409,000. You leave almost $250,000 on the table. So again, really, really important to stay invested. Those good days and bad days often live in the same neighborhood. So it's really hard to tease out when you're going to have those good and bad days, and nearly impossible to get that timing right. So another thing to think about as we think about the basics, right, is, the financial media and the financial press. So if you're watching it, chances are you might want to stop. You might be a lot happier. And something I always encourage in my clients is to be mindful of incentives, right? What are the incentives of the average financial media? It's, generally speaking, to sell advertising, right? It is to stoke fear and to tune your eyeballs in for a longer period of time. The more scared or outraged you are, the longer you're going to tune in, the better for them, the more ads they're going to sell, right? So be mindful of incentives. This is also true when you're talking to, planners or advisors, right? And you're interviewing who you want to work with. Figure out what their incentives are. It's okay to ask, how do you get paid, right? What does this look like? What do you believe in? What's your philosophy for long-term success in the market and partnering with investors? So just something to keep in mind. Think about the incentives, especially of the talking heads on TV, and something to be mindful of, right? So now let's get cooking, right? Let's put this into action. What does that look like? One is just automate. So here's a tip for your emergency savings. So we talked earlier about putting 5% of every paycheck, putting it into an emergency savings account. Put it somewhere that it's not super easy to get to, and that you can do it automatically, right? So it comes, the paycheck comes in, boom, it goes 5% automatically. Your bank can likely set this up. for you, right? Where 5% of what comes in goes to a certain account. And my recommendation, it might sound kind of counterintuitive, but if it's real easy to transfer in and out of that emergency savings account, you might do so for something that's not an emergency, right? So something to think about. Maybe there's a little bit of friction there, right? Maybe you invested in something, even if it's in a money market fund, but if it's in a brokerage account, right? A little bit harder to pull that out. You got to request it. It takes a day or two. So just something to think about automating and maybe putting a little bit of friction so that it makes it a little harder. You have that little extra check and balance in that emergency savings. And what you're seeing here is systematic investing, right? If I have an investing goal, like I invest in my 401k, every paycheck at work, what you're seeing is, how long does it take to accumulate $1 million by age 65? And how much would I have to put in if I start at different ages? Well, if I start at, age 15, right, takes, $60 every month. I've invested 36,000 and I end up with $1 million, right? So my 15-year-old self, I would have loved to have had that advice. Conversely, if I wait till I'm 55, boy, that's going to take a lot more every month, and that could be a bridge too far for many folks, myself included, right? So we're going to wrap up here, and we're going to talk about having a plan, right? So really, having a plan, protecting our wealth. What does protecting our wealth look like? Again, we're talking about our financial foundation, having a secure financial foundation for ourselves, for our families, if we have a family. So one thing is having a plan. Another is income protection, right? What happens to my family if I don't come home from work today, right? What happens to them, right? So life insurance. What happens if I, have an accident and I can't work, right? Disability income protection. No one likes thinking about these things. No one likes talking about these things, but it's incredibly important to consider. And a lot of these risks are pretty inexpensive to insure against. Some are expensive to insure against, right? But just important to think about them and have a plan, right? And talk to a planner, talk to somebody who can help you through some of these decisions. The other is estate planning, right? And I know that sounds fancy, and a lot of folks think, well, I don't have, I'm not wearing an ascot, I'm not multi-generational wealth. I don't need an estate planner, but it's really simple stuff, right? Having a durable power of attorney, a living will. Are my accounts, titled correctly? Are my beneficiaries, up to date and current, and everything matches, right? Real simple stuff, and stuff that you can, work with a planner and execute on. And then, obviously tax strategies, right? And tax planning. So what does having a plan look like? Well, if you look here, right, it's having a map, right? It's having a roadmap and having somebody to work with that's going to coach you through the process and what your next steps are. Right. This doesn't have to be complicated. It doesn't have to be scary. It can be pretty simple, right? So what does having a plan cost? Right. There's a lot of resources. You can do it yourself, right? That's part of what we're trying to teach here. Is teach you that, to figure out, is this something I want to do myself? If you do work with a planner, count on it costing about $1,300. These are national averages. Some are going to be more, some are going to be less, but somewhere in the neighborhood of about $1,300. Some planners will work hourly. Some will work on a subscription fee, like a monthly subscription fee. We're seeing more of that. Complex plan, that's going to be if you have rental properties and a few more moving parts in your life. That's when you can see the plans become a little bit more time consuming and a little bit more expensive. But this gives you an idea of what working with a planner costs, and really to help you decide, is that something I'm going to benefit from, right? And am I going to get some mileage out of that? Also important to note, this is not like a one and done thing, right? Life events happen. People have kids. People's family lives evolve. The financial pictures evolve, right? These are all important things to consider. That this is a dynamic objective here. This is a dynamic plan. It's not something that we just do once and we forget, right? So quick plug here that if this is if you're still with us, go ahead and scan that QR code. It's going to take you to a landing page where you can subscribe. We're going to be hosting this type of content and delivering it to your inbox monthly moving forward, starting at the end of summer here in 2023. So very excited about that. Please do snap a pic of that, plug in just first, last, and email. We're not going to, spam you, right? You're going to get, one educational content piece a month, and we're really excited to be rolling this out. And certainly, please if this interests you and you think you benefit from it, go ahead and scan that and pop your info in while we're wrapping up. So with that, I always, I find myself doing a lot of things that I used to laugh at my grandfather and father for. One is using this adage, right, which is, when's the best time to plant a tree? 20 years ago, right? When's the second best time to plant a tree? Today. So the real goal here is, if we didn't plant that tree 20 years ago, let's do it today, right? None of this stuff matters unless we put it into action. And in my personal life, a lot of these things were things I needed to work on and be better at. And I'm excited to put these into action. I really hope that you're in the same boat. Let's plant that tree. Let's get a plan in place, whether we do it ourselves, whether we're working with a planner. Let's build a budget. That's our starting point. Let's tackle that debt if we have any, and that's a priority for us. Let's build that emergency savings, right? 5%. Automate. Call your bank, right? Talk to somebody and say, hey, how can I make it so 5% of my paycheck goes into an emergency savings? And they can likely point you in the right direction. Certainly give us a call. We're happy to talk you through some strategies. And then investing in your future, right? Once we have that solid financial foundation, let's plan for the future. So I'm going to put some important disclosures up on the screen. And with that, just a quick thank you to for taking your time to be brilliant on the basics. Thanks for sticking with the program here. Please do share any feedback that you have. Track us down. Again, the goal of this series is to help support the important financial decisions, both in your workplace retirement savings plan and beyond. So excited to have a conversation with you. Thanks so much. Hope you find this valuable, and we'll see you next quarter. Thanks so much. So long. Bye-bye.